The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin, Jeong. In a time of persistent market volatility and tightening credit conditions, investors are on the hunt for alternatives that can offer both stable returns and downside protection. One area gaining traction is private credit, especially when it's structured to provide asset-backed security and exposure to resilient markets like real estate. Today, we're diving into how IFS Asset Management is opening up institutional-grade private credit opportunities to a broader investor base. Their model not only offers a pathway to portfolio diversification, but also channels much-needed capital to businesses through a structure backed by real assets, including properties in Singapore. So how does this work, and what kind of risks and returns are involved? Why might private credit be this smart defensive play for investors navigating uncertainty? Well, to find out more, joining me now is Charis, Liau, who is the Chief Investment Officer of IFS Asset Management. Charis, welcome to the show.
Hi, thanks for having me. It's great to be here.
Thank you so much for joining us. Well, Charis, with, market volatility on the rise, what makes private credit an attractive option for yield-seeking investors right now?
Private credit has been gaining a strong momentum, especially over the last couple of years among yield-seeking investors, and I guess this is for good reason. So in today's environment of heightened market volatility, private credit does offer a compelling mix of yield, capital stability, as well as downside protection, features that are increasingly difficult to find in public equities or traditional bonds. So that's to put volatility into perspective. The VIX Volatility Index, which we often refer to as the fear gauge of the markets, we saw that it spiked in August last year, 2024, to its third highest level since the 2008 financial crisis. This was primarily driven by persistent concerns around a U.S. recession. However, despite all of this turbulence in private markets, we saw that private credit has actually continued to deliver stable returns. So, for example, the data from Preqin, which tracks a 14,500 private credit funds, actually showed that performance in the sector has remained very resilient. And also looking back historically over the last 25 years, we see that private credit has consistently outperformed traditional indices, including the S&P 500, as well as the MSCI World Total Return Index. And this index actually tracks performance of developed market equities across 23 markets, about 1,500 different companies. So this long-term track record reflects private credit as an asset class, very strong fundamentals, particularly in its ability to generate yield through secured lending strategies while minimizing exposure to daily market swings.
Okay, so how do you see the role of private credit evolving in a diversified investment portfolio, especially compared to traditional fixed income?
Yeah, so private credit by nature of itself is in the private world. So today, if you just look at the listed companies, right? So less than 19% of companies in the US with revenues over $100 million are publicly traded. So in the entire universe of investable assets, if an investor only limits himself or herself to only consider public securities, essentially the investor is actually cutting off about 80% of the rest of the economy. And in the UK and EU, this proportion is actually even higher at about 92 to 94%. Asia is even much higher at 98%. So that's primarily in private credit itself. It is slowly and becoming a core component of diversified investment portfolios, especially as investors seek alternatives to the traditional fixed income asset class. So while public bonds do remain important for liquidity and defensive positioning, it has actually faced challenges in recent years to keep up with inflation due to the rising interest rate volatility. So come private credit, it does offer a very differentiated risk-return profile. It does typically provide higher yields, often backed by real assets or cash flows. It also provides tailored structures, structured by the fund manager or by the private investment houses, for example, and it comes with a stronger investor protections, typically through collateral or through financial covenants. And because such loans are typically privately negotiated, they can be structured to reduce any interest rate sensitivity, if any, and also align very closely to investor objectives. And I think the other important factor is that private credit tends to have a lower correlation to public market volatility. So that makes it actually a very valuable diversifier in very volatile environments. And it has demonstrated resilience as we've seen over time. So I think, looking ahead, this asset class, as you continue to institutionalize this, especially in under-penetrated regions like in Asia, we believe that private credit will move from an alternative allocation into a more strategic income-generating core holding in people's portfolios.
Are there particular macroeconomic signals then that are driving investors toward asset-backed instruments?
Yeah, absolutely right. So there are a few macroeconomic signals that will drive investor demand. So firstly, as you all know, we are operating in a period of persistent global uncertainty. So whether is it a volatility in terms of interest rate movements or geopolitical tensions, ongoing inflationary pressures, we do see that investors are seeking greater stability and downside protection. So in an asset-backed kind of instrument, especially those secured by receivables or real estate or other types of collateral, such security can actually help to preserve the capital of the investment. Secondly, traditional fixed income hasn't actually kept pace with inflation over the last couple of years. So investors are also seeking for yield, but they are also cautious, right, with regards to risk appetite. So again, asset-backed private credit can offer such higher returns due to the illiquidity premium, as well as the downside protection via collateral. And I think lastly, there's an evolving banking landscape that's a major driver. So ever since the global financial crisis in 2007-2008, we have seen that regulatory capital requirements have constrained bank lendings, especially to the SME segment. So this has created opportunities for private lenders to step in. And as a result, over the last decade, right, since 2007, we have seen an expansion in private credit by 8 times, from about 200 billion to 1.7 trillion in 2024. So from our perspective, this environment has reinforced, the value of our strategy. And we do see Singapore emerging as a regional private credit hub. And I think we're very excited to be a part of that growth story.
Well, speaking of which, I believe IFS Asset Management has its own private credit model. How exactly does it work for both investors and borrowers?
Yeah, at IFS Asset Management, our core strategy focus on private credit lending to SMEs, and this is secured by high-quality Singapore real estate as our investment portfolio. This allows us to deliver stable, risk-adjusted returns with strong downside protection for our investors. So what we do is we combine rigorous credit underwriting, first legal mortgages over properties, as well as certain financial covenants or guarantees that we procure from the business owners. Essentially, this is to preserve the capital and to ensure a very strong alignment of interest to ensure that all of the investments that we put out gets repaid. So our team does have deep local roots. We are backed by our parent group's presence in Singapore, IFS Capital since 1987, who is also listed on the Singapore Stock Exchange. So this actually enables us to better understand and be deeply rooted into the local SME segment to originate quality deals. For investors, we're actually opening up this access to a very traditionally exclusive asset class while providing a stable, consistent return for them. And similarly for the borrowers, essentially our kind of value proposition for them is to provide fast and flexible financing, especially to those who need additional working capital, but they are not able to procure this fast enough. So I guess by combining collateral together with our market expertise and a very active loan collection, monitoring and servicing capabilities, we bridge SME financing gap whilst, delivering a very consistent and stable, resilient income and downside protection for our investors.
Okay. So how does IFS Asset Management ensure the institutional grade quality of its, private credit opportunities?
Yeah, our success as a asset manager, together with the track record that we've had over the last couple of years, can actually be attributed to a very rigorous credit underwriting that we undergo all of our investments through, as well as active loan monitoring and strong collateral assets that we procure from each of our investments. So we have a team of investment professionals that firstly identifies high-quality private credit opportunities that can deliver this very consistent risk-adjusted returns. And each investment is then very carefully structured and packaged to essentially maximize the value while mitigating downside risk through a very rigorous due diligence process. From our perspective, we typically look at each deal through the lens of, whether the borrower is able to repay as well as their willingness to repay. So from that perspective, we look at various things like, cash flow, timing of repayment, loan structuring, the asset quality, the ownership, the liquidity of the asset, for example, as well as we place a very high value on the borrower's track record, and reputation and intent to repay. So we do prioritize very high quality credit opportunities, and through structuring the transactions with a very strong resilience and downside protection in mind, we ensure stability even throughout all market cycles. And more importantly, after the loan is being refinanced out, we always have a very active portfolio management process where we have a local team here on the ground to actively monitor each and every single loan performance. And that allows us to respond very proactively to borrower if there's any, signs of stress or late payments, etc.
Very interesting. So what makes the structure lower risk then from an investor's point of view? What kinds of safeguards or covenants are in place?
As an asset manager, our core focus is on capital preservation and stability. So we achieve this through a multi-layered risk management framework, and that's built around very secure asset-backed lending. So as mentioned earlier, every transaction and every deal that we see and we originate will always be fully collateralized, and very often is typically with Singapore real estate. So this offers a very clear and forcible recovery path in the event of a default of a borrower. And this is already our first line of defense for investor capital. So additional safeguards and risk controls that we do procure for every transaction, includes, things like a in-house proprietary model that we deploy to basically assess our borrower's risk and to ensure the quality of the real estate collateral. So as mentioned earlier, we do consider their ability and their willingness to repay as well as the track record. We do assess, publicly available valuations, especially for real estate. And in Singapore, a very robust legal system does enable us to easily, assess the quality of the underlying asset collateral, and it allows us to enforce our security rights. For every transaction, we maintain a very conservative, loan-to-value ratios to ensure, significant security buffer in all of our transactions, thereby reducing the risk of capital loss, even in stress scenarios. We also structure our loans to be typically 12 months, which are short-term in nature. And this allows us to very actively and manage, and also reprice interest rates, right? Quickly adapting to, changing market conditions or to reduce exposure to long-term market conditions and market shifts. And finally, as mentioned earlier, we stay very deeply and closely on the ground through in-house loan servicing and collections team. And for any private credit funds, I think this is really critical because at the end of the day, it's really to allow us to proactively manage every single loan and manage the portfolio to allow us to detect any early warning signs, if any, and to take any action when needed.
So how is exposure to Singapore's property market structured within these private credit opportunities?
So collateralization with Singapore property is a deliberate and core component of our risk management strategy, and that underpins our capital preservation philosophy. So in private credit, particularly when lending to SMEs, downside protection is really key and is top priority. So, and we do know that in real estate, especially in Singapore, it offers a very unique and stable, transparent, and very enforceable form of security. So in Singapore, property is supported by a very deep and transparent market, and it has historically been very, very resilient in values. So even during periods of economic uncertainty, for instance, we note that property value here actually retain value much better than any other asset classes in the region. So this allows us, together with our investors, and provides us a strong layer of protection in any event of borrower distress, if any. But however, I think we don't really just only rely on collateral alone. We do conduct very rigorous due diligence on the borrower's business and underlying credit quality. But having the property as a collateral just helps us to price risk more confidently and also offer competitive terms to borrowers and deliver stable return to our investors. So I guess in summary, right, it's really about leveraging on property as collateral to allow us to strike the right balance between supporting business growth as well as maintaining, a very high bar for capital protection.
Well, given Singapore's property market, how do these, asset-backed loans balance risk and return for investors?
Yeah, so Singapore property market is, as you know, one of the most stable in the region, and hence it makes it a very ideal foundation for asset-backed lending. And private credit loans that typically comes with strong covenants as well as asset collateral And in this case, it actually ranks senior in the capital stack of a company, and having the collateral allows us a very tangible layer that reduces the downside risk for all of our investments. So for investors, it doesn't mean that we're just only relying on the borrower's cash flows. The underlying asset can hold long-term value and can be recovered in a default situation. And this offers, much higher returns due to the illiquidity premium of a private credit investment class. And this allows investors to actually earn a higher return as compared to traditional fixed income. So in essence, it's actually a strategy that combines capital preservation with steady income, leveraging the resilience of Singapore property market to really balance the risk and the return effectively for investors.
Well, speaking of risks here, before we let you go here, Charis, what are the biggest risks investors should be aware of when considering asset-backed private credit?
Yeah, I would say liquidity will be a key consideration because private credit investments are typically not public traded. They are private in nature. So investors would usually be required to lock in their capital for a certain limited period of time. But in return, they do benefit from a lower volatility because it is, away from the traditional equity and bond market. And they can also enjoy higher yields compared to traditional fixed income. For private credit, because it's lending to companies, I would say the borrower risk is also another important factor. So whilst asset-backed private credit is generally secured by collateral, the creditworthiness of the borrower remains central. So the borrower needs to be able to finance and repay the loan when it comes due. However, such risks are typically mitigated through a very robust structuring, deep market knowledge, putting through the active monitoring of every transaction and strong legal protections. So the other thing is that investing through a diversified fund structure would actually also help spread risk for the investor across a portfolio of underlying borrowers rather than, concentrating their exposure on a single particular loan. And I would say lastly, I think the experience and capability of the fund manager would also be very crucial for an investor to consider because successful private credit investments does require very deep local knowledge of the market, a very disciplined underwriting process that goes through it, and very, very close borrower engagement. And managers with strong on-the-ground presence and proven track records are typically better positioned to manage risk and deliver stable, consistent return to investors.
Some great insights from you there. Thank you so much, Charis, for joining me today.
Thank you, Hongbin.
Thank you. That was Charis Liau, who is a Chief Investment Officer of IFS Asset Management. This has been The Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.